Creative real estate financing methods, specifically ones that work, ones that you'll want to embrace for maximum opportunity as this market is shifting. And I'm gonna let you in on what's working right now and what's gonna work for a while. You ready? Let's go. All right, so before we're done, you're gonna know several creative financing methods that can jumpstart your investing career or expand your existing one. And as the name states, creative financing, you're limited only by your own creativity. But these 10 or a combination of any of them are gonna get you started. And stick around until the end. Should you want some additional help, I'll tell you how to get it. So in real estate, the term creative financing is used to describe any type of financing arrangement that doesn't involve a conventional mortgage loan like the ones most people use to buy their homes. And what most people don't understand when it comes to creative financing, as long as the buyer and the seller agrees, anything goes. A seller has the right to sell their property for whatever they want for it, however they want. I mean, if they trade their house for a plate of chicken and waffles, they can do that. And that would certainly be creative. And I'm actually still working on that one, but let's get more practical, because it was being pragmatic that gave birth to creative financing. You see, it was during the late 70s when the 1973 oil embargo crisis, it plunged the economy into a period of hyperinflation. And the Federal Reserve attempted to counter the hyperinflation by raising interest rates. Eerily similar to what we're dealing with today, right? Thus the importance of brushing up on your creativity. You see, prior to the embargo, mortgage interest rates hovered around 7%, but fairly quickly jumped to 17%, pricing most home buyers out of the market. And because it was more difficult to qualify for and even afford a loan, the need for creative financing was born. And I'll run down 10 different creative financing methods that you can use right now. But real quick, if you're already starting to see how creative financing methods will be useful in the current market based on what's going on, let me know by hitting the like button. And if you like making money in real estate, subscribe to the channel and click that little bell icon so that you're notified when new videos here are released. I mean, we do it every week. So number one, the cash out refinance. So this is a transaction in which you tap into the equity of your home, which frees up idle funds to invest elsewhere. And this move here, this can be an uncomfortable one for some people because they hold a higher value in owning their home free and clear than they do of financial independence. So I'm not gonna hold this against anybody if the goal is to pay off their home. But it does tell me that they don't understand how the velocity of money and inflation works when it comes to creating wealth. So this is my request. When that next investment opportunity comes across your desk and you need the funds to make it happen, just do the math. Weigh the costs of the refinance versus the benefits of that investment and then make your decision that way. Number two, the home equity line of credit, or commonly referred to as a HELOC. Unlike a cash out refi, with a HELOC, you don't pull cash out of your equity, you borrow against the value of your equity. It's a subtle difference, but there is a difference. HELOCs generally, they have a draw period, typically lasting 10 years or so, and a repayment period, often lasting no more than 15 years. So when would you use a HELOC and not use a cash out refi? It's perfect for doing repairs or upgrades, like for your income properties. It's ideal for situations for smaller amounts of money and for shorter periods of time as opposed to a full property purchase. If you need more money and for a longer time, maybe option one, the cash out refi, would probably be the better option. Number three, a personal loan. Though a personal loan, it doesn't offer the same great tax benefits as a refi or a HELOC would, there are some compelling reasons to consider it. For one, you likely won't be required to put up your property as collateral. In many cases, you aren't required to put up any collateral at all. Second, it's advantageous in real estate to have some sort of liquidity giving you the ability to act fast and get that particular deal done that requires such speed. Now this next one, this one's my favorite and the one that I use most often. Number four, seller financing. This is when the seller of a property agrees to stand in place of the bank. So instead of making payments to a bank, you'll make payments to the seller. I mean, think of it as buying a house with an IOU to the seller. So Purchasing a property with seller financing can get pretty deep when it comes to finalizing the terms of that financing. So if you'd like a copy of the creative terms cheat sheets that I give to my private clients, you can grab a copy for free at epicbreakthrough.com. I'll put that link down below in the description for you too. So I built my entire passive income portfolio and escaped the proverbial rat race in less than 4 years by combining seller financing with number 7 on this list. But let's look at number 5 right now, and that would be lease options. A common school of thought among real estate investors is that it is always better to buy than rent. The problem with this sentiment is the word always. You see, it ignores the fact that lease option contracts are a very viable route to buying property. Real estate investors of all experience levels may occasionally encounter a property they are not ready or sometimes able to purchase, which is where a lease option contract can make for a perfect fit. A lease option allows investors to take control of a property, typically to generate some passive income for a period of time, and maybe do some repairs or rehab along the way, while holding the exclusive right to purchase the property at a predetermined price by a predetermined date. Number 6, a self-directed IRA. So investors with existing retirement savings can tap into that money prior to retirement without penalty through a self-directed IRA. So this technique gives investors control over their retirement investments as opposed to relinquishing it to some financial planner or the human resources department at their day job. If you don't already have an IRA, the setup process is relatively straightforward. Reach out to us over here. I can connect you with the best person in the business. Number 7, private money. Private money is relationship money, meaning it comes from your private relationships, like your friends and your family, your neighbors, your coworkers, or essentially anyone else you'd like to involve in your investing. See, you'll be able to negotiate more flexible loan terms with your private money lenders because the entire transaction is less business-oriented. So here's a tip for you though, especially if asking someone that you know for a loan feels a little awkward. Well, rather than asking them for a loan, offer them an opportunity to make more money with you than what they're likely doing with their money at the moment. Given the investment opportunities that are available to the average person these days, it's not difficult to do better for your friends and family. Number 8, hard money. You see, a hard money lender frequently was, at one time, a private money lender, and they liked the results and decided to go ahead and make a business out of it. So while the terms of hard money can vary greatly from loan to loan and lender to lender, often it's more expensive than anywhere else, there are several scenarios where it can be very useful. And one of the reasons hard money may make sense for you is the approval requirements are typically asset-based rather than credit score-based. So if you've got a good deal that you want to buy, it can be much easier to get funding as there's limited personal underwriting involved. Another reason hard money can make sense, hard money can move quickly. Like if you need funds in a few days, it can happen just like that. This can be a great option if you need fast money. And establishing a good track record with a hard money lender can result in even faster money, in bigger money, more flexible money, and with lower rates. Number 9, FHA loans. These are loans that are backed by the Federal Housing Administration. And FHA loans are perfect for first-time homebuyers who don't qualify for a traditional loan. So while you are still technically borrowing from a conventional lender, this loan, it allows those with lower credit scores of 580 or above, to pay as little as 3.5% for a down payment. But keep in mind, you'll initially have to live in this property to qualify. But when you're ready to move, it can become a super income property for you. Using an FHA loan can be an excellent low-risk method for getting your investing started. And then number 10, crowdfunding. Now this financing strategy is relatively new and allows investors to use money from the public. And several well-known crowdfunding platforms like GoFundMe or Kickstarter, it authorizes users to raise money for anything that they want. However, a website like Feather the Nest is a crowdfunding platform designed specifically for real estate investors and home buyers. So you just go create an account, make your case to the public, and just wait for the funds to roll in. So a traditional mortgage can be a great way to purchase real estate, but a creative way could be, and often is, much better. And if you'd like to take the first step and dive deeper into creative financing, I've got a series of free lessons that break down each one of these methods that I mentioned and so much more in much greater detail. You can get them all for free at creativefinancing.us. That's it for now. Thanks for watching. I'll see you next time. Take care.